What we see as money is fundamentally broken. It actually fundamentally does not carry some of the most important characteristics of money, which is store of value.
What do people need to understand about money before we actually decide how to build wealth?
Most people think that money is currency. Money is a mechanism to transport your economic energy through time and space.
How is what you just shared related to our money being stolen away from us? Like, how do you couple those things together?
For the last 60 years, we've been printing or creating 10% more money. You're losing half your purchasing power every 7 years. You're losing 99.9% of your purchasing power every 15 years.
You had $1 million that you were sitting on because you've been told that's what you need to do or you need to save, and that would be worth $300 of purchasing power. That is fucking wild.
This is actually way more serious than most people give credit to. All of the money you have in the bank is not your money. It's actually owed to you by the bank. You can have whatever you want in life. All you need to do is one tradable commodity on earth that you can always get more of is.
It is getting harder to get ahead as a modern day human, to pay the bills, to build wealth, and to actually live a life of freedom, something that so many men and women struggle with. And within that struggle, we end up sacrificing our health, our happiness, and our sanity sometimes to actually live the life that we want to live. Goose McGrath, I see you as an expert in Australia and the world on not just building wealth, but also living a life by design. So today's going to be an epic podcast where we break down how you can build wealth in money and finance while also building wealth in your personal life. Goose, welcome to the show. How are you feeling?
Hey, Tony, I'm really excited to be here, actually. And it's a topic that I'm really passionate about. And I actually think that what you just touched on then is really, really interesting because, we can talk about money and making money and like what all that's about. But I think you first have to ask yourself the question, like, why? Like, why does that even matter? And for me, the fundamental reason, I would agree with you. I would say that I know quite a lot about macroeconomics, building wealth, all of this kind of stuff. But the whole reason I've even gotten interested in that is because of the other side of the equation. What do we actually want to build wealth for? To live a life by design, to be a sovereign individual. For me, freedom is one of my highest values. And so everything to me is centered around how do you create a life that's aligned with your values, and then building wealth or actually working out how to get ahead, even though getting ahead is getting harder, is actually really just a fundamental stepping stone to achieving the thing that you really want, which is, different things for different people. You want to spend more time with your family. I know that because I know you. And, for me, I want to be able to live where I want, do what I want, with who I want. There's all of these elements of freedom that come from the idea of building wealth. So, yeah, I'm excited to be here, man. I'm really excited to dig into it.
Amazing. So we're going to start with what is money. And this would have been shared in the intro, but you've built one of the fastest growing companies in Australia, hundreds of staff over the years, and you know how to create that freedom. But before we dive into it, what is money? What do people need to understand about money before we actually decide how to build wealth?
So I think let's take a little bit of a sidestep, right? Because most people think that money is currency. So if you're an Australian listening to this, you would think that your Australian dollars are money, whereas in fact they are currency. They're a political currency. So they're a token that is representative of money, right? And so many things have been used as money over the years. Everything from wampum shells to tobacco to glass beads to gold. There's been lots of different things that have been used as money. So then that necessarily begs the question, well, what actually is money? Now, there's some sort of technical definitions that, it's a store of value, unit account of medium of exchange. But the way that I like to think about it is money is a mechanism to transport your economic energy through time and space. And the degree to which something can help you do that is the degree to which it carries moneyness characteristics. And so a simple way to think about that is if you were to go and chop wood, right, for someone, for an old lady or something like that, and you're going to charge, say, $20 an hour, what you're really doing is you're exchanging kilojoules for the hope that person is going to give you a transportable mechanism that you can expend those kilojoules at a point in the future at your discretion. So you may burn, 500 calories, or you convert that to kilojoules, right? So I actually think the interesting philosophical point is I actually think that we have the completely wrong unit of measurement for money in the first place. It actually should be kilojoules or calories or some kilocalories or something like that, because what we're actually talking about is energy transfer. But
Yep.
if you were to take a certain, you expend 500 calories chopping wood, you want to exchange that for a tokenized mechanism to be able to transport that energy that you've expended at that point in time to a place that you can expend it in the future. That might be sitting in a bar, buying a beer and relaxing, or it could be transporting it for your retirement. Now, the problem that we have is that what we use as money, or what we see as money, is fundamentally broken. It actually fundamentally does not carry some of the most important characteristics of money, which is store of value. So some of the other characteristics of money, or some of the moneyness characteristics, like unit of exchange, medium of exchange or unit of account, they're important. But I would argue that the single most important characteristic is store of value, the ability for something to transport your energy effectively into the future. And the issue that we have in Australia and the US, and in fact the entire world, is that the entire world is currently run on a fiat currency system. Now, fiat is a derivative of a Latin word that means by decree. So basically, that's because I said so. So why is this $20 note worth $20? Because I said so, but it's by decree, right? So you have this money that only actually has any value because I said so. And since it became decoupled from a hard money standard, what I mean specifically is when it moved off a gold standard and was able to be printed, then you actually started to really break down the fundamental aspect of its store of value. Now, I'm going to circle back to this. This is really, really important for everyone to understand. When money, or when currency was backed by gold, it was effectively an IOU certificate for gold. Now, why did that matter? Why was that important? Well, because gold was a scarce, it still is, scarce, desirable, store of value. So the stock to flow ratio on gold is very high. That means that there's very little new supply coming into the market versus the amount of gold that exists. So therefore, the value was able to be stored and transported easily through time. So gold was the best form of money that we had as a species for a very, very long period of time. But it had some fundamental problems. It's not easy to transport. It's hard to verify. It's not easily divisible. It's not a very good actual way to conduct commerce. And so what they did is they said, let's take gold and let's actually put a mechanism over the top of gold to make it more usable. And that mechanism was currency or IOU notes. Now, that's all well and good up until the point that somebody recognized that you could print more of the notes without actually producing any more of the gold. And that became decoupled. Those two things became decoupled from each other. And that began a period of monetary debasement, which is another way of saying a devaluation of the currency. And the simplest way to think about that is, in Australia, if you take all of the goods, services, and assets in the entire country, and you divide all of that by the amount of dollars in the country, you would effectively have the value of the currency, right? So you'd say, however many dollars in the country divided by the total value of all the goods, services, and assets. If you doubled the amount of dollars, but you haven't doubled the value of the goods, services, and assets in the country, all that would happen is it would cost you twice as many dollars to buy the same amount of things, right? So it would cost you twice as much for the same thing because the dollars have doubled, but the assets haven't, right? So therefore, in optical terms, things would cost more when they actually haven't changed anything. Nothing about their utility value has changed at all whatsoever. Now, to illustrate this point and to illustrate sort of how this is happening, we often look at the boomers, right? And they had it easy and all that kind of stuff. In fact, there's nothing wrong with the boomers. Everyone kind of shit cans the boomers and say that they had it easy. They stole everyone's wealth. They bought all the properties. They did all this kind of stuff. The fact of the matter is, we really started to decouple from the gold standard in around 1971. Most boomers were born before 1971. And so what they experienced the end of a stable monetary era, and they were at the beginning of a period of time where money started to inflate disproportionately to the amount of assets that are available. When I say assets, I mean goods, services, assets. I mean everything that holds value within an economy. And by the way, this idea of money, the supply of money divided by the goods, assets, and services in a country, it's called the quantity theory of money from the Austrian School of Economics. So it's a well reasoned theory. Now, that is why. I'll give you an example. That is why, for example, my dad, I was visiting my parents the other month, and I was talking to them about the house that we grew up in when I was a kid. And we were driving past it, actually, because they still live in the same town. And I said, how much did that property cost to buy? Because they bought it before I was born. I think they bought it in 1983, before my brother was born. I I said, how much did that property cost to buy it? And it was a brand new property. They built it. So it was like a house and land package, right? So they built it, brick, tile, brown brick, brown tile, classic 1980s house, quarter acre block, big shed, nice big tree in the backyard, like classic, classic Australian dream, like the epitome of. And I said, how much did that cost? And he said, oh, about $33,000 all in, $33,000. And I was like, that's super interesting. Now, bearing in mind, this was just before my brother was born. So both my mum and dad were working at the time. But I said, Dad, what was just your salary at that time? And he said I was getting paid X amount an hour, and we did the maths and whatever. It worked out to be $35,000 a year.
If you're getting value from this podcast episode, please do me a favor and hit that subscribe button and the bell icon. It allows us to reach more men, to keep more families together, and to give you more value with the guests that we get on board. So please do me a favor, hit subscribe, hit that bell icon so we can give you even more value. So
right,
1 year's worth of salary would have built your dream Australian home.
Bingo. The Australian dream was available to a single person salary. Now, I was talking to someone the other day, a young woman, and I think she was 29 years old, earning $280,000 a year. So she's in the top 1% of earners for her age. And her challenge was that she was unable to afford to buy a home where she wanted to live. She couldn't afford it, which was absolutely insane when you think about that. And so the real question is why. And the reason that is the case is because the money, or the monetary system that we're involved in, is debasing our purchasing power by a very significant amount over time. And Tony, I'll keep talking. So you need to cut me off if you want to get a word in edgeways.
No, this is fantastic. I mean, what I'm understanding you say is that money in itself is a broken system, and that broken system is fueled by printing it with no inherent value. And that in itself is creating a world where it's getting harder and harder to get ahead. Not just live your dream life, simply get ahead. So this ties into the question we had lined up, which was, how is what you just shared related to our money being stolen away from us? Like, how do you couple those things together?
Well, let me give you some numbers around this, because this is really, really fascinating. So I did some independent research on this myself, right? So I like to do a lot of research. I love numbers. It's what I do in my spare time. So I looked at there's different forms of money, right? So in Australia, there's M0, which is base money, which is basically all of the actual physical cash, dollars, notes, physical money. Then there's M1, which is a broader basket of money, which includes liquid assets and stuff. Then there's M3, which is the largest basket. The rest of the world predominantly uses M2, which is sort of partway between M1 and M3 in terms of what kind of how far a scope do they bring in. But Australia typically uses M3 as the primary unit of money, how much money is in the system. So I did an analysis on M0, M1, and M3 back as far as the records showed on each of those forms of money, how much existed. So M0 base money over the course of 50 years, from 1975 to 2025, had an average compound annual growth rate of 9.32%. M1 over 50 years, over the same period of time, had a compound annual growth rate of 11.3%. M3 had a compound annual growth rate of 10%.
So what does that mean for us?
Yeah. So what that means is that let's just kind of simplify it and just call it 10% for simplicity's sake. That means that every year for the last 50 or 60 years, in the case of M3 money, for the last 60 years, we've been printing or creating 10% more money, which means in practice, everything's should have been getting 10% more expensive. Now, that is why house prices have been going up at the rate they've been going up. Now, the question you're going to ask there is like, well, why haven't prices gone up? Like, why haven't all goods and services gone up by 10% a year? Why is CPI only 3%? And that is that I'll circle back to this, but that's actually because of productivity. Now, the issue with governments printing 10% of new money each year, I say printing very loosely because most money gets created through credit creation. That's where most of the money comes from. We live in a debt-based society. Most of it comes through credit creation. Every time a loan is created, new money is literally created into existence. You go get a loan, you go get a mortgage. No one's moving dollars around. They're just like making up new money. That's when
it's
money
fake money, isn't it? It's not real.
No, none of it's real.
Fabricated. Yeah,
none of it's real.
None of it's mind-blowing.
It's absolutely mind blowing, right? So, and you know what? Just as a little sidestep here, I don't know how I worked this out, but I realized at a very young age that the one tradable commodity on earth that you can always get more of is money. Like I worked that out somehow, like when I was like 12. So I was like, okay, who cares about money? Because it's just all make believe shit anyway, right? So it's useful because you can buy stuff with it, but it's actually mostly fabricated. So the problem is we're basically having our wealth taxed away from us by governments printing money, or by a monetary system which debases the currency, because it's not just governments printing, so it's not like this, but through a system that debases or devalues the currency by, on average, 10% a year, 10 to 11% a year. Now, we get income tax, and I'm sure that pisses off everyone, but also we're getting taxed on our savings, because if you put $100,000 in the bank and do nothing with it, the purchasing power of that money is going down by about 10% a year every single year. So basically means you're losing half your purchasing power every 7 years, and you're losing 99.9% of your purchasing power every 15 years.
So just to pause on that point for anyone to understand that, if you have $100,000 in the bank or $1 million in the bank for a rainy day, or because you've been told you should save or whatever, in 7 years that 100 grand is worth 50.
Yeah, it's only going to
it'll have the purchasing.
It'll have the purchasing power of $50,000. So this is
meaning half of, you can buy half as much. What do you mean by that?
Yeah, you can buy half as much. So the way to think about it is, like, if I had $100,000 in the bank today, okay, right, what could I buy for $50,000? Let's say you could buy 50,000 $1 items, right? Just for the point of the discussion. In 7 years, those 50,000 $1 items will cost you $100,000, because your purchasing power will have gone down. So your $100,000 will still optically read, your bank account will still read 100,000. It'll still say 100,000. You don't actually lose money to 50,000, but what you can buy actually goes down. Your purchasing power goes down. Let me put some numbers around this, because this is absolutely freaking crazy, right? So if we use M3, which is the main measurement that the RBA uses to measure money, right? This is why we use M3. Since 1975, M3 has grown by a total of 29,557%. Now, to put that in different context, the purchasing power since 1975 of a dollar has dropped by 99.66%, which basically means that if you had a dollar today, it would be able to buy you what in 1975 you would have been able to buy for 0.35 of a cent, 0.34 of a cent, which is crazy, right? And so, if you had $1 million today, it would get you the equivalent of, what's that, $340, what you would have been able to buy for $340.
Let's just pause on that point. You had $1 million that you were sitting on because you've been told that's what you need to do, or you need to save, or you shouldn't get into bad debt, and that would be worth $300 of purchasing power. Like, that is fucking wild.
Yeah, correct. Yeah. And so that is what is fundamentally wrong with our system. Now, when you compound that so our money's being debased by about 10% a year, wage growth is only about 1.5 to 2% a year, right? So those two things that math ain't mathin'. That's why you've gone from single wage income households that were able to have a house and a car and 2 kids. And, once upon a time, it was feasible for our parents' generation. They were able to, from the fruits of their labor, provide satisfactory housing, satisfactory education, satisfactory childhood, all that kind of stuff, right? Now you have people, and that was in their 20s, by the way. You had parents at 22, 23 years old, building a family, being able to provide on a single income with a stay-at-home mom, or maybe a stay-at-home dad or something like that, but a single income. In today's day and age, you've got professionals in their 30s, in like the prime of their career, asking themselves the question, can they even afford to have a child? Now, that is, and most people are feeling this pain. They're going, like, why is this getting harder? Like, why is it that no matter how hard I spin the wheels on this, I can't seem to make any traction? Why do property prices go up disproportionately to wages? Why do I feel like I'm never going to get anywhere? Why was it so much easier for the generation before us? And it is because we have a money or a currency that is debasing at a faster rate than our wages are increasing. And typically that money is flowing into harder assets. So hard, scarce, desirable assets, that are not easily fungible, that are good stores of value, all of these kind of things, are actually where the money flows to, which is why real estate disproportionately actually grows even faster than monetary debasement because money seeks safety. And so it flows out of things that are unstable and unsafe into things that are stable and safe. And so that is actually why property prices have increased broadly at a faster rate than monetary supply certainly over recent years. Over the long-term horizon, it's fairly similar. So I think
so
this is actually the biggest. Go on. Yeah.
Just to dive in here, like this can sound very much like despair. And I learned this probably 2 years ago, and I started investing in property 5 years ago. I've bought 8 properties. Our portfolio is worth almost 8 million. We've got $3 million of net worth. I'm 33. But for the average person listening right now who is a nurse or a firefighter or a business owner with 4 staff and big tax bills, like how the fuck do you get ahead when the system is ultimately rigged against you? Like, where do you even begin?
Well, let me come back to that because I don't want to be an alarmist. I'm an optimist almost to a fault, right? Like my natural programmatic worldview is that everything's going to be awesome, like everything's great, right? So I don't want anyone to think that I'm an alarmist or a doomsayer and I think the world is. But one thing that I've realized is that this is actually way more serious than most people give credit to. And I actually think it's very important that we actually spend a bit of time to explore that because once upon a time, investing was something that you could do just because you wanted to make a bit more money. It was kind of like an optional extra. You didn't really need to do it because once upon a time, you could actually save your money and you could save your money and it held value into the future. In fact, if we go back far enough, if you go to the Renaissance period, the entire reason the Renaissance period actually took place is because the currency of Florence, wasn't being debased for 400 years, didn't get debased, which meant that everyday people could save their money and it was worth the same in 100 years, 200 years, 300 years, which meant that people could save and become wealthy through their savings. And that's actually how the Renaissance flourished because people like Leonardo da Vinci, they had sponsors. They had people who saved money and said, you know what, I'm going to spend a little bit of this money on sponsoring this guy to go and draw pictures and invent things, right? And that's how society progressed. That's how society progressed. Now, so I really want to emphasize the importance of this characteristic because you can't save your way forward. Now, one of the issues that we've got is we're moving into the biggest deflationary period of our species, full stop. And that is being driven by technology evolution, technology advancement, technology. Now, AI is a big part of that, but it's not the only part of that. There's a whole bunch of stuff that's moving forward. Now, what has happened over time is the monetary debasement rate has been everything's exponential. So on the short tail, the two things are pretty close together. The rate of productivity in acceleration and the rate of monetary debasement are pretty similar. But over time, they both start to compound and they both start to go exponential. And so what you can actually see is if you look at CPI versus monetary inflation, you can actually see how much prosperity is being robbed away from us by monetary inflation. And so if just for simple maths here, just to make it easy for the listener to consume, if the monetary debasement rate is 10% a year and consumer price inflation, CPI, which is that massively distorted metric anyway, so that's not even true, but let's just use that as a metric, is 3%, the natural question is, where's the other 7%? That 7% is the deflationary force of productivity gains through technology. The simple way to think about this is like a jar of Vegemite. These are not exact numbers, but a jar of Vegemite 30 years ago might have cost 50 cents, right? And now it costs $5. Now, do you not think that with the advancements in productivity, better factories, more efficient technologies, all of that, do you not think that the price should have gone down?
100%.
Do you not think that it should have gone from 50 cents to like 5 cents? So why has it gone the other way? And so we have these technology driving prices down and then monetary inflation driving prices up. And these two things are the forces that are really starting to split away from each other. And I think over the next 5 years and 10 years, I think this is going to be the single defining characteristic of our lives and certainly our economics, is that specific force. I call it the deflation-inflation paradox, because on the one hand, we want and need technologies to improve our lives, to be able to create more efficiency, to create more freedom, to be able to create more prosperity and abundance. And by the way, we have way more abundance and way more prosperity than we've had in any other generation. So whilst we did have harder money in the past, we have better healthcare and a whole bunch of other stuff today. The problem is, everything should be way cheaper, but it's not. And so that is why we have to apply a disproportionate amount of effort to buy the same things. Like the jar of Vegemite that was 50 cents is now $5. And the degree to which productivity forces prices down is the exact degree to which governments are going to be forced to inflate the money supply. Because governments are built and funded on a debt-based monetary system. And deflation breaks a debt-based monetary system. Because when you have deflation, that means that your debt is worth more in the future than it is today. When you have monetary inflation, debt is worth less in the future than it is today. So when you're in an environment where you have a lot of monetary inflation, like, get debt. It's the best thing you could ever do, because your purchasing power is going to be, let's say, going to be cut in half in 7 years. So I can borrow $100,000 today, and if I pay it back in 7 years, let's just pretend I make no repayments on it. I could just pay it back in total in 7 years. I'm only going to be paying it back with $50,000 of purchasing power at that point in time, right?
Can I just stop you on that point?
Yeah.
So just so I can understand it and the listener can understand it. So you said something earlier, savings can no longer create the life that you want.
Correct.
And what I'm hearing you say is that if everything's getting more expensive or is inflating, right? One of the best things you can possibly do is take debt, whether it's from the bank or anywhere else, use that debt to buy hard assets, aka property. And because inflation is lowering the purchasing power, that debt actually is less debt in the future. It's the same amount of debt, but it's deflated in terms of how much you pay back. Is that what you're saying?
Yeah, that's exactly what I'm saying. So an easy way, let me try and reframe that, an easy way to conceptualize. So if you can understand that the value of your money is being eroded by 10% a year. If you give me $100,000 this year as debt, and I pay you back in 15 years' time, that $100,000 that you gave me, I'm going to pay you back when it's worth less.
Yeah.
Right.
That makes a lot of sense. And that's why property works so well. And that's why I'm so big on using debt. People are like, you're so much in debt. I'm like, well, that's the fastest and best way for me to build wealth and beat the system, which is rigged against me.
100%, 100%.
Yeah.
So look, there's 100 million things that we can talk about this topic, but you've kind of like lent in there to a key point. So it's kind of like, if the monetary, if the currency you're using, to kind of use the correct term, is being debased by, let's call it 10% a year, just for simplicity's sake, the question you need to ask is, well, what are you going to do about it? Because you can't keep the money in savings, because it's losing value all the time, right? And that's why the pension system doesn't work. That's why superannuation doesn't work. That's why, like, none of this stuff works. You have to be able to work out, okay, how do I preserve my economic energy and transport it through time and space? So you've actually got to work out, well, what's the hurdle rate? So if the monetary debasement rate is 10% a year, how much would I need to make my money grow in order to beat that? So at the bare minimum, I can transport my economic energy through time and space and have at least the same amount, or in fact, maybe more. So then you have to start to work out, what is your hurdle rate? So your hurdle rate obviously needs to be more than 10% if the money is debasing at 10%, right? But then what about things like taxes? Okay, so let's say you invest in assets and then you sell them, you're going to pay taxes. Well, okay, you got to factor that in too, which is why I don't think ETFs or anything like that generally. So let me clarify: the S&P 500, for example, which basically tracks monetary inflation, that doesn't work. It may very well track global liquidity increases in monetary inflation. It basically might go up at the rate that money gets produced. But once you sell it in the future, you're going to have to pay taxes on it. So you're guaranteed to make a loss, right? You'll have to pay capital gains tax on it.
That's wild, because I was always told, and I read it from Tony Robbins' book as well, which was person I looked up to so much, still do. And it's like, invest in the Vanguard ETF or the Vanguard Index Fund, and you'll make 8% or 12% a year. But even if it's 12% a year after tax, I'm still behind. Correct. And I've taken all this fucking money I've earned for years, I'm putting it into something so I can be wealthy in the future, and I'm in the same fucking position or worse. Yep. It's mind blowing.
Yeah. And it's a really good point, because this is the difference between optical value and real value. So like, let's say you buy a house, right? Let's say you buy a 4-bedroom house, 4-bedroom, 2-bathroom house for $500,000. If in 10 years that property is worth $1 million, what has actually changed about that house?
Nothing.
Nothing has changed about that. Utility value hasn't changed. Still 4-bedroom, 2-bath. Like, maybe there's some demand dynamics that more people would have lived there at that point in time. But we're actually talking fairly minor stuff, because probably more suppliers already come into the area as well. So optical inflation. So, I put all this money into a Vanguard ETF and I put in $100,000, and then whatever, 10 years later, it's worth $200,000 or whatever the number is. That's optical. It's not real, right? So you actually have to calculate the real rate of return, not just optically number goes up. But that's a fundamental. And
that's where the hurdle rate comes in. The hurdle rate is, so 10% a year is what you need to beat. What is the hurdle rate or the percentage that we need to be aiming for?
Yeah.
I know it's individualized, but what can we aim for as a percentage each year for our money to grow?
Yeah.
Like, so is that the question?
Yes. I think it's a fantastic question. I think it's the first question you need to ask, because otherwise, how do you even know what to invest in?
Yes.
Like, do you buy bonds? Do you buy any equities or whatever? Right. And we need to think in a couple of different dimensions here to wrap our heads around it. Risk adjusted return is actually one of the key ones. So, okay, we know we need to beat a 10% debasement rate. Fine. But we also then need to be able to factor in taxes. Okay. So that's probably going to be 25%. If it's long-term capital gains tax, it's going to be about 25%. Okay. So that puts us at 2.5%, right? So that's another 2.5%. So now we're at 12.5%. Right, then you're going to have a risk premium on top of that as well, because there is no risk-free investment. In fact, one of the problems with a broken monetary system is it forces us to seek risk, because our money, our energy cannot be effectively stored in the money. So we necessarily must go and seek risk in order to try and gain a premium to be able to transport our economic energy through time and space. And so then you necessarily have to carry a risk premium to it as well. And the risk premium, should be, what is the probability of loss, right? So you may say, okay, you might pick an asset and you might say, look, it's a very safe asset, but there's maybe a 5% chance that I'm going to lose my money, right? So then you would put a 5% risk premium on that as well. Very simplistically, you need to get to about at least 14%. My personal hurdle rate is 20%. So I want my money, my wealth, all of that kind of stuff to be compounding at least 20% per annum. Because I don't want to just tread water at roughly 14%. I actually want to get ahead. Now, my target rate is about 40% per annum. But my minimum is
wild. People
to
even imagine 40% growth year on year, compound annual growth rate. People will go, that's not possible, because that's what they've been told. Right?
Totally. Yeah. Totally. But it absolutely is possible, because we're doing it every single day, right? So understanding that and defining your hurdle rates actually is very clarifying, because then it actually reduces the amount of things you would think about investing in. Because, like, I don't know, would you invest in, soybean futures, for example? Well, yeah, maybe they're going to grow by 3% a year. Okay, who cares? Not going to beat my hurdle rate. And so when I look at things, I'm looking at them very specifically through the lens of what is the risk adjusted return profile, and is it going to beat my hurdle rate, basically. And so 14 is typically a really good guide for a minimum return that you should seek to expect, which is exactly why things like the S&P 500 doesn't work. That's exactly why most managed funds don't work, because their returns are about 12 to 13% roughly. So you're still not going to get there. One index which does work is the NASDAQ, which is interesting, because the average compound annual growth rate of the NASDAQ is about 20% per annum. So that's actually pretty good, right? As far as indexes go, you can invest in the QQQ or something like that. It's actually pretty good. And the reason for that, very specifically, is tying back to what we were talking about earlier, which is technology-driven deflation. Because when you have technology that is driving deflation, those technologies that are actually driving that deflation, they capture and consolidate the value of that deflation over time. So that is why we're getting a concentration of more like multi-billion and trillion-dollar companies, and we're actually hollowing out the middle. So if you look at the Russell 3000, you're actually going to find that most of the small to medium-sized businesses in the Russell 3000, they're actually dead. They're basically zombie companies. So we're starting to get a bifurcation of the business sector where you have billion-dollar giants or million-dollar niche businesses. And I think that is actually going to be the way in the future. And this is actually a really interesting kind of point of view. Is for anyone sitting here today listening to this who's like, you know what, I'm going to go build the next, I'm going to go build an empire. I know when I started, when myself and Gabby started Dashdot, I was like, we're going to build this thing for 40 years, yada, 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 all that kind of stuff. Like, yeah, if you started in 1980 or 1990, like maybe that's a realistic point of view to have. But the question you got to ask yourself if you're going to like build a massive empire is, can you continue to innovate faster than the aggregate global rate of productivity advancement? Which AI is doubling roughly every 6 months, right? So
it's very difficult to do.
Extremely difficult to do.
I want to make something very clear as well. This is not financial advice, and we'll put that disclaimer at the beginning as well. But what I'm hearing you say is, if anyone listening right now, not financial advice, their money is not growing by at least 14% a year, look at it deeply and question what you are currently doing, because your money is getting eroded every single day. So you have a strategy. It's like a trifecta or something when it comes to hitting these numbers. How does somebody who has been saving their entire life, your typical listener, how do they start this? Where do you begin with this journey? How do you fix it?
So the way that I think about this is there's three core buckets of assets that I think people should invest in. I call it the sovereign trifecta hedge, because what is important to me personally is sovereignty, personal sovereignty, right? Which to me is a translation of freedom. I want to be free to live my life in my way, on my terms, right? And I think that sovereignty and self-actualization, I think they're the two primary goals in life, certainly for me. And so when I look at the system that we've got, which is a system that is fundamentally driven by monetary inflation, that is being significantly impacted by productivity-led deflation, and the degree to which there's productivity-led deflation is the degree to which monetary expansion will continue to happen, because governments can't allow deflation to occur in there because the entire economic system will break. Then I ask myself, how do I hedge myself against this future?
When you say hedge, for someone who doesn't understand that, you mean minimize the risk, right?
Well, what I mean is I want to place multiple bets on various upsides, right? So how to
diversify yourself?
Well, diversification is probably not how I would think about it.
Okay.
It's how do I create a portfolio that benefits from all of the forces that are pulling in different directions, so that heads you win, tails you win is the easiest way to think about it, right? So
that's a much more simple way, because when I hear you speak about some of these terms, I'm like, and I sign up to a newsletter about global liquidity. I'm like, fuck this. That was the most simple frame, is like, how do I win regardless of what happens? I like that frame a lot.
So yes, exactly. So heads you win, tails you win. That's what you want to do. That's basically hedging, right? So, and so the way that I think about it is this: there's three parts to it. There's Australian residential real estate. It's very specifically Australian, very specifically residential, and I'm more than happy to explain why. But we'll keep moving for the moment. So Australian residential real estate, Bitcoin, and exponential age assets. Now, the reason that those three things form a trifecta, right? And for me, they're my sovereign trifecta. They're my ticket out of here. They're my ticket to escape a broken system, so I can live life on my terms. And the reason they're a hedge is because real estate, Australian residential real estate, is basically placing a bet that governments are going to continue to expand the money supply. And as they continue to expand the money supply, asset prices, specifically housing in Australia, is going to continue to rise in optical terms. So I'm betting that governments are going to keep printing money, or that credit creation and the monetary supply is going to continue to inflate. I'm actually betting that it's going to go up more in the future. I'm not a hyperinflationist, by the way. Some people think about hyperinflation, and we could talk about. I'm not a hyperinflationist. I actually just think that we're going to have systemically high monetary inflation for a protracted period of time. So Australian residential real estate is placing a bet that money supply is going to continue to increase, which I'm very, 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 very sure about, unless they invent a new monetary system. So the second one is Bitcoin, which is actually a way to take your economic energy out of the broken monetary system. So there's one that's going with it, saying, okay, you guys are going to print more money. Great, I'm going to put a bet on there. And then I'm going to put a bet. I'm going to take some of that money off the table. I don't want to bet with some of the money. I'm going to take it out of that system and put it into an alternative system which can't be inflated, can't be printed. And that's a real key thing, right? There's all these other characteristics of Bitcoin that we can talk about as well, but it's a fixed supply. It's got a tremendously high utility value. People say it doesn't have utility, but what greater utility is there than transporting your economic energy through time and space effectively without decay and erosion, right? It's transportable, immutable, safe, secure. So what Bitcoin is about to take your money out of the system. And then exponential age assets, which are things like there's 8 categories. So artificial intelligence, AI infrastructure, energy, robotics, biotech, space tech, cybersecurity, and crypto and decentralized systems. They're the 8 categories I look at in exponential age assets. That is a bet on all of the stuff that is going to cause deflation. So one bet goes with monetary inflation. One bet goes, that's property. One bet goes with productivity-led deflation. That's on the exponential age assets. And then one bet is taking your money out of the system entirely. That's Bitcoin. And those 3 things basically work in concert with each other. They actually should all win at the same time, but for different reasons specifically. And that's what I like about it.
If you want to actually take this framework that I shared and apply it to your life, it's part of our Empowered Man Armory and our app that we've spent almost 250 grand on. If you want access to a powerful system where you can use this reframe system I just shared with you every single day, then find me on Instagram at Toni Empowered Man, ToniEmpowedMan. I'll put the link down below as well. Send me a DM saying reframe, and I'll give you this exact framework as well as early access to the Empowered Man app when it launches. I love that. And a lot of people might hear that and go, well, that's too much. That's already way too much for me to think about. So I want to sort of share a story about my journey, and I'd love for you to speak into it. We recently put the majority of our company profit into a Bitcoin treasury, and we're just holding Bitcoin because due to the research I've done and conversations I've had, I think it could 5 to 10x in the next 5 to 10 years. That's a pretty good bet for me, right? The other thing is Australian property. And I think a lot of people have the story that it's too hard, you can't afford it anymore, etc. I bought my first property for $420,000 in one of the most dangerous suburbs in Australia, Elizabeth Vale, Adelaide. Bought that for $420,000 4 years ago. I put in $80,000 for the deal, including finding someone, a buyer's agent or a company to find me the property, right? We're about to sell that property for $860,000. So for anyone listening, we bought it for $420,000, we're selling for $860,000. That's a $440,000 gain. I put in 80 grand. My math could be off. I think that's a 5.5x on cash invested. So what people don't realize when it comes to debt.
How much did you put in? How much did you put in? Sorry?
80 grand.
Yeah.
80 grand. And to hold, it's probably cost us another 40 because we bought really high yields. So let's say we put in 120 grand to make 440, right? So that's a 4x. Yeah. That's a 400% gain over 4 years. The hurdle rate is 10%. So people don't realize this. And I was always told that debt was bad. I'm about to pull out 800 grand because we worked so bloody hard to get these small properties that we didn't need 200 grand for. And I'm going to buy as many as I can. So I'm using that debt to actually grow my wealth. 2 years ago, my net worth was 900 grand. It's now $3 million. I haven't saved $3 million. Fuck no. I think I've saved like 200 grand over 4 years.
Yep.
So can you explain how that works? Let's start with property. What are the common misconceptions people have around Australian real estate, and how can they start this journey? So
in my opinion, so in case people can't tell from the fact that the things that I just spoke about, I'm a very passionate investor. I'm very passionate about numbers and money and global economics and all this stuff. I invest in Bitcoin. I invest in some other crypto stuff that falls in the exponential age assets. I invest in a whole bunch of stuff, robotics, space, all this kind of stuff. And I'm really interested in it. And I've done very, very, very well out of it. But in my opinion, Australian residential real estate is the best risk-adjusted return asset on the planet. Now, a lot of really hardcore Bitcoiners would challenge that. They would say that Bitcoin is the best risk-adjusted return. It's so safe and the likelihood of it. That's all good. But what they're missing is the return profile. So Australian residential real estate is exceptionally safe. It is slow. It is stable. It is all of these things, which is why banks love it, by the way, And the fact that you can leverage it, because banks love it, because it is so slow and so boring and so stable, is in fact how you can effectively get an infinite money glitch out of it, and not only get the returns that you got, but actually amplify those returns.
Yeah,
So
it's exponential. I'm noticing that our property portfolio is going like this. For anyone not watching, like it starts like a flat line,
Yeah.
and I can clearly see on above average wage, 190 grand a year, how I can be worth $15 million by the time I'm 40. Like that is
Correct.
insane to me. Yeah.
Correct. Because it's a non-linear compounding. So I'm going to get back to some of the mechanics of property in a second. But
Sure.
let's say you buy a $500,000 property with a $100,000 deposit, and then let's say that $500,000 property becomes a $600,000 property, and you take $100,000 out of that property and you go buy another $500,000 property, and then that goes up, and then you've got two properties growing. The first property goes from a 600,000 to a 700,000. You take 100,000 of that. The second property goes from 500 to 600,000. You take 100,000 out of that. You got $200,000. You go buy another two properties. This
So just slowing down. Year one, you make 100 grand by parking your money. You double your money, 100% gain.
Yeah.
Year two, you make 200 grand.
Yeah.
So you've now gone from 100 grand a year to 200 grand a year in 2 years, and you haven't really done anything except park your money in the right place.
Correct.
Is that correct?
Yeah, that's correct. So that the point of that is not actually about the returns. The point of that is about your ability to leverage the equity out of those assets to buy more assets. And so what you end up with is this kind of fractal explosion. You buy one asset, that asset actually produces the capital to buy a second asset. Then you have two assets that are growing. They produce more capital. You can leverage the equity out of those and buy two assets. So now you actually have four assets. Then you have four assets, they're growing. You can take the capital out of that and go buy another four assets. And then you're at eight, right? And so it goes very exponential, very, very quickly. So there's an exponent in your portfolio which allows you to amplify your wealth. But just to bring this back down to some numbers, right? So let's say you have let's say you have $100,000, right? Or let me put this slightly differently. So let's say you were going to buy a $500,000 property and you didn't want to use debt. You wanted to just buy that in cash, for example, right? Or you could go and use debt. Now, if you go and buy a $500,000 property in cash and it goes up by 10%, how much money have you made? $50,000. You've made a 10% return. Okay. Now, 10% is okay. Monetary debasement rate's 10%. So you might be like, all right, well, you're going to lose out on taxes, but hey, better than keeping your money in the bank. But if you, for example, put down a 10% deposit, so $50,000, and then roughly say 7% in purchasing costs, you would be at roughly $85,000. We'll call it, right? Roughly $85,000. Mm-hmm. If that property goes up by 10%, it's gone up by $50,000. You've made a 58.8% return on invested capital in the
so almost 6 times more return.
Yes.
Simply by shifting the way you think. And I know you want to riff on this, but I want to share a point because I sent a client to Dashdot and this client had paid off 850 grand of their mortgage. And I calculated this on the 7% interest, they were saving, what was it, like 60 grand a year. Yep. If they took that money and bought 4 properties, those 4 properties could make them 400 grand a year. So they could almost 10x their money by making a different decision.
Totally. 100%. Yeah. 100%. Yeah. So going back to this example, let's say you had 500 grand of cash and option one was buy one property for $500,000 and it goes up by 10%. Option two is, you put in roughly $85,000 to buy one $500,000 property and you're going to get a 50. And if it goes up by 10% as well, you get a 58.8% return on invested capital. But you're actually forgetting about the fact you still have over $400,000 still sitting there of the same equivalent 500 grand. So in fact, you could buy 4 properties and still have change. And if they went up by that same amount, you would have a 58.8% return on invested capital on all of that money. It's massive, right? So it's a huge difference. And just on the kind of like people paying off debt and stuff. Now, I think it's a very emotional thing. Like if people want to pay off their home and own the home debt free, I can understand that from a sovereignty perspective, like to like be like the owner and not be beholden to someone. And I kind of get that from an emotional perspective. And so I respect people's choices to own a home. I respect people's choices to want to own a home debt free. From a purely financial perspective, though, that doesn't make any sense. And when people pay principal and interest loans, that doesn't make any sense to me either. Because what they're saying in their mind is, I'm paying down debt, and that is good to pay down the debt. But in a very practical sense, the return that you're getting by paying down the principal on a loan is only equivalent to the interest rate that you're paying on the mortgage. So let's say you've got a 6% interest rate on your mortgage and you're making additional principal repayments on your property. Your return is in effect equivalent to the 6% interest rate you've got on your mortgage. Now, we've already established that you need to have a hurdle rate of at least 14%, preferably 20%. And so those repayments you're making to pay down the debt faster are actually getting you further behind, not further ahead. If you took that money and deployed it elsewhere, the question you would ask yourself is, can you get a better than 6% return? Now, if you've got $250,000 sitting in an offset account because it's offsetting. Now, it's one thing if you need to do that because you can't afford the cash flow, fine, totally, no problem. If it's a cash flow management strategy, do what you got to do, right? Because you've got to still be able to make the repayments. But if you've got $250,000 sitting in an offset account because you're trying to offset the interest rate on your mortgage, or if you've got $250,000 of lazy equity sitting in your home doing nothing and you don't want to take it out because it's going to cost you 7%, what you're actually doing is you're sacrificing the delta between the 6% and what you can get, which is 50, 60, 70, 80, 100%. And back to your point earlier, a lot of people think that getting 40% returns in a year is, unfathomable. One of the best investors of all time. In fact, many people say he's a better investor than Warren Buffett. And oh my God, his name's just completely slipped my mind. But I'll come back to it. But he got 40% compound annual growth rate each year for 30 years, right? And he was considered to be Stanley Druckenmiller is his name. He's considered to be one of the best investors in the history of investing, full stop, all time. The thing is, that's very hard to do on a large scale when you've got multiple billions of dollars of assets or tens of billions of dollars of assets. But it's actually not that hard to do on an individual level. Like you can very easily, work that out. My personal return profile is typically way more than 40%. So it's typically in triple digits. I went from having no money 6 years ago to having what I would say is a significant net worth now. I remember the first time I woke up and accidentally realized we'd made $1 million in equity just by doing nothing with our properties. I was like, how did that happen? All of a sudden, we've got $1 million. And so these things can happen if you know how to deploy the capital. And all of the attributes that people say are negative attributes of Australian residential real estate, it's expensive, it's slow, it's boring, all of this kind of stuff, are actually the reasons it becomes an accelerant. And if you know how to play the real estate game, you can get better returns than you can even in Bitcoin. And Bitcoin, bearing in mind, has been the best performing asset in the best performing asset class in the history of humankind. It's grown faster than any other asset class in the history of the planet. But you can actually get better than Bitcoin returns if you know how to play the Australian residential real estate game. Now, why Australian residential real estate? Why not US real estate? Why not UK real estate? Why not Chinese real estate? Well, there's specific structural policy and demographic influences that make Australian residential real estate extremely powerful in moving forward. So, for example, in the US, they have non-recourse lending, which means if you buy a property and then you can't make the repayments, you can literally just walk out of the property and that's it. No one's going to come after you. You just walk out. And that's actually a big part of what happened in the GFC is they had non-recourse lending. So all these people couldn't pay their mortgages. So they just stopped. And it was, the banks have to deal with the houses then. In Australia, we have recourse-based lending, which means you can't walk away from the debt, which necessarily, from a policy perspective, structurally supports the idea that we don't have these kind of these bubble type scenarios because people can't get themselves into those conditions. We also have better prudential regulation and lending regulation to make sure that people we're not creating kind of debt bubbles in Australia. In addition, over a 10-year period, I measured it last year, and I think it's actually gotten worse. And I actually have some more recent numbers as well. But over 10 years, from 2014 to 2024, there was a negative 2.2% compounding annual growth rate of building approvals. That meant every year there was 2.2% less building approvals than the year before.
So less supply, but more demand?
Well, I'll get to the demand side in a minute.
Yeah.
But just wrap your head around that. In a country where the economy, where the population is growing, and I'll get to the population in a second, there was 2.2% less building approvals every year than the year before. So that's crazy that we have a declining building approval rate. But we also had accelerating immigration. So we've had something like 2 to 3% immigration rate over the last 10 years as well. And in fact, I actually have some numbers here which are pretty wild. So over the last couple of years, net overseas migration has been running at 25,000 people per month. and new dwelling approvals are just 14,000 a month.
So there's nowhere to put everyone.
There's nowhere to put everyone. And the problem has gotten so large that in order to solve the problem, it would be one of the largest social and physical engineering projects ever conducted on the planet. It would be up there with like some of the biggest, most ambitious projects that are happening in Saudi Arabia right now, where they're just trying to build all these crazy big things to try and solve that delta, to try and build enough houses to be able to solve that. So the only way to change that equation would be to stop immigration. But Australia can't do that because Australia's economy is so deeply supported by the addition of new people into the economy. Because if we didn't have net positive migration over the last few years, we would have been in a recession. In fact, we had a per capita recession. We had 21 quarters or 21 months in a row where we had a per capita recession, where a GDP decline on a per capita basis. And the only reason the economy sort of stayed in positive territory and we didn't officially go into a recession is because we had so much migration. Now, just to be clear, because I don't want to sound like I'm anti-migration, I am very pro inclusion. I'm very pro migration. I'm all for it. Like I'm not out there saying shut the borders, ban the boats. I'm not saying any of that kind of stuff at all. I'm just pointing to the economics of the situation where we've had way more people coming into the country than the properties. We already had a deficit. And now we've exploded that deficit, or the gap between the amount of people who need properties and the amount of properties there are, to the degree that it's almost unsolvable on anything less than, say, a 10 to 20 year time horizon. And that would require some serious work.
And just to drive that point home, so everything you just shared around property, is that what makes it such a good bet? Because of the immigration, because we're printing money, because we're not building enough homes, it's very unlikely that it doesn't continue to explode, right? Is that accurate?
That's basically the thesis, right? Now, what's actually, and there's nuance to that, of course, but basically you've hit the nail on the head. There is way more demand than there is supply, and that's structurally embedded and probably isn't going to get solved. I would be surprised if that gets solved in the next 20 years. In addition to that, the government's going to continue to print money, and that money flows into assets like real estate, disproportionately flows into real estate in Australia versus other assets. In the US, it flows into equities more than real estate. So different markets, different economies do behave differently. But in Australia, it flows into real estate much more than it flows into equities. The Australian equities market is not really that very, very good. And in fact, global liquidity also affects the Australian real estate market because Australia is a net importer of capital, which basically means we actually bring in money. We don't just print it ourselves, we also bring in money from outside. Yeah. So those things kind of point to the structural reasons why real estate is going to continue to make such a powerful bet into the future.
I want to touch on Bitcoin in a second, but there's two things I want to bring up. One's a statement, one's a question. I think a lot of people can listen to this and they'll go into the typical Australian tall poppy. I'm just your average Australian bloke. I'm just your average nurse, etc. I can't make all this money. I don't have $500,000 goose. And they'll go into this victim mentality. And I want to make something very clear. Whatever you believe you can or can't do, you're right. If you had told me 4 years ago that I'd have this net worth and I can work 20 hours a week and have a family life with my 2 daughters, I would have told you to get fucked. But it's possible. And it's only possible because I made a commitment to study this, to learn about this, and to find experts to support me in it. Because like you, I realized that my money is getting wasted away. It's getting burned to the ground. So to anyone listening right now who is thinking, well, fuck you, Tony, you're wealthy, or fuck you, Goose, you're wealthy, and it isn't fair, and I'm so far behind, I can't catch up. Just stop, take a breath, and question that. Now, to that point, let's say somebody has that negative mindset, or they're like, yeah, this sounds great, Goose, but I don't have 500 grand. What is the minimum amount someone would need to get started in Australian real estate? Because I think what they believe is I need to buy in Sydney and Bondi or whatever. Yeah. You and your strategy is very different, right? Yeah. So what's required for the typical Australian who's like, I want to start? Like, what's the minimum threshold?
Yeah, I'll circle back to that because it's a really interesting point where you mentioned Sydney, because I actually asked my brother-in-law, Gabby and I aren't married, but Gabby's younger brother, a few years ago, because he was like in his early 20s. I said, why are you and your friends not interested in real estate? He's like, oh, because we don't have $1 million. Because the perception was if you wanted to buy real estate, you needed $1 million. The median house price in Australia is $1 million. We don't have $1 million, so we're going to go and bet on meme coins and see if we can make money that way. That's the psychology. And to put that in context, and there's some truth to that too, by the way. I mentioned how my dad my parents, bought a property on 1 times my dad's salary. In Bondi, the average house is 29 times the average salary in Bondi. The average salary in Bondi is about $145,000 a year, and the average house price is about $4.1 million. So no wonder people get scared and they go, "Oh my God, this is unattainable for me," because it certainly feels that way. When we think about to get back to your point, how much money do you need to get started? Probably $80,000 to $100,000 realistically. That doesn't mean you can't buy cheaper properties. You could go buy real estate with less. The question you need to ask yourself is it the right property in the right place at the right time for your strategy, right? And so from a very practical perspective, I think that $80,000 to $100,000 is really where you want the entry point to be, and you need to be able to make sure you're making the right decisions. Now, the way that sort of a bit of a heuristic that we use for selecting the right location is based on 3 things: jobs, lifestyle, and relative local affordability. And the relative local affordability is a really, really big one, because it doesn't mean just go and buy cheap properties. And you're not trying to compare like the average national household income with, you actually have to look at the location specifically. And you have to actually ask yourself, is this property affordable in a local context? And so, because some people might be like, what, you can't go buy properties for $500,000 that don't exist, or $300,000 or $400,000 that don't exist. They exist all over the place. Yeah, they exist all over the place, right? Now, granted, when we started Dashdot 6 years ago now, I think the cheapest property we ever bought was $175,000, I think it was actually. And by the way, that was a screamer, turned into like a $320,000 property or something like that. They were very happy. But we were regularly buying properties in around $250,000. That was sort of a pretty consistent price point. Now we're more consistently buying in the sort of $400,000 to $500,000 price points. You can still get $300,000 properties though. They're just harder to find those kind of properties in the places that you would want to buy that it makes strategic sense from a long-term, from a good investment thesis perspective. But you can definitely do it. So to answer your point, it's sort of $80,000 to $100,000, and that is still a chunk of change, right? That is still hard. Like that's still really hard to do.
It's almost $2,000 a week over a year. It's like about
totally
$1,700 a week. Yeah.
And the issue is actually that it's getting 12. I calculated it based on the increase in migration and the declining building approval rates, and a whole bunch of other stuff. It's getting 12.4% harder each year to buy a property, which basically means every 6 years, it's getting twice as hard to buy a property. So you might go, okay, I need 80 grand today. And if it takes you 2 years to save up 80 grand, you probably don't need 80 grand anymore. You probably need 100 or 110. So it's actually getting harder and harder and harder. But that's not going to change. Here is the thing. That's not going to change. So when you hear that, don't throw your hands up in the air and go, I'll come back to it later. Because when you come back to it later, it's going to be harder. Like you have a really strong impetus now to actually start to take action. And I'll come back to like, how do you build up to that? Because the sovereign trifecta hedge actually does help you to do that. And I'll come back to that because it's very practical steps you can take. Sure. But the problem that we face right now is we are the first generation where consciously, if we have kids, we're going to be bringing them into a world where they'll experience less prosperity than we will. So our parents' generation, we're the last generation, realistically, where the generation where they experienced more prosperity than the generation before them. They had kids, and their kids are now struggling, working out why they can't buy a house and all that kind of stuff. We're struggling. We have kids. We're like, okay, my kids are going to have it even harder than me. So we actually know that it's going to be harder for them than it was for us. But when our parents were born, they expected things to be easier. There's a big difference psychologically. And that's actually, I think, potentially the first time in history where we're at a turning point where it's actually going to be harder for our kids than it is for us. The rest of human history, with some significant exceptions in places, things like the Dark Ages and stuff like that, where there was massive social decay, but very broadly, society's been on a prosperity uptrend. Everything's been getting easier and better. If I think about my grandparents, my grandmother was so poor that she used to have to walk along the sides of the train tracks trying to find pieces of coal that had fallen off the trains so they'd have fuel to cook their food, right? That's 2 generations. So my grandmother told me that story. And
My
then
grandmother told me she was getting shot at and my grandfather was running away from bombs and they would eat a potato each once a week. Like,
yeah,
we have it so good right now, but you're right. It is getting harder.
and it's getting harder, right? And
Yeah.
so when you sit there and think about, okay, is this difficult? Yes, it is difficult. Like, I guess own it. It's difficult. I'm not going to sit here and be like, you've just got to save more and spend. It's like, actually, structurally, there's a problem. And so you got two choices. You can bury your head in the sand and wake up in 20 years and wonder why you'll never get ahead, or you can recognize the system you're in and you can start to take action to get yourself out of it. That's really the choice that you get to make. And if you ever want to bring a family into this world, or if you currently have kids, you owe it to them, your current family or your future family, to take action now. Otherwise, they will never get ahead. I'm speaking to more and more people, and they're investing not for themselves. They're investing because they know that their kids are screwed if they don't. So investing has gone from something that's an optional extra that you could do if you've got a little bit of extra cash, that maybe it's going to buy you a nicer boat or something in the future, to an essential aspect of your existence, because without it, you will suffer, you will be devoid of prosperity, and you will live a sad life in the future when you'll never achieve the life that you truly deserve. That's just the fact of the matter. Now, I'm in the investment game. I don't think that's good. Socially, I don't think that's good. But my opinions don't matter. My emotions don't matter. What matters is what is. And so that's why I really care about helping people to navigate this. That's why I'm really passionate about helping people to escape the status quo, because they've got to do something. And this is what drives me and motivates me every single day in my business. Now, if you are in a position where you don't have the money to get started, and if you can't save your way to wealth, if you can't save faster than the 12.4% that is getting harder every single year to buy a property, what do you do? Well, that's where the other aspects of the sovereign trifecta hedge come into play, because you can use other assets to accelerate your capital to help you to get into a position to be able to then buy real estate. Because I believe that Australian residential real estate, that's the apex asset that you can own. Now, there are things about Australian residential real estate which make it really difficult. The entry requirement is pretty hard. Like, it's very expensive to get into it. And you will find limitations on how big you can grow your portfolio. Almost everyone will. So there'll be a certain amount that you can play the game in real estate. There's no maximum limit in Bitcoin. You can just keep going, right? There's other stuff that has other attributes. But I still think that primarily Australian residential real estate should be the anchor for, if you're an Australian resident, you can get Australian lending if you can borrow in Australia. Australian residential real estate should be the anchor asset of your portfolio. But to get there, to accelerate your capital, if you've got $5,000 and you're wondering how do you get to 85 or 100 grand, well, you need to start thinking about investing that capital now, not just saving it, not just going, okay, I'll save my dollars in the bank because it's getting eaten away at 10% a year. You're never going to get there. So you need to think about, how do you take that money that you've got, every single dollar you've got, how do you get that to beat the hurdle rate? Now, I personally think Bitcoin is a really good investment opportunity. Again, not investment advice, not personal financial advice, all of that kind of stuff. Do your own research. For me, I believe it's a great opportunity, but you have to have the right time horizon with it, because you might invest in Bitcoin now, and if it continues to go through its 4-year cycles, you may find that it's worth less in 2 years than it is today, but then it's worth a lot more in 4 years than it is worth today. So you have to have the right investment time horizon. Similarly, with exponential age assets, you can make great returns on that if you know how to invest in those things. So you have to invest in education. You have to invest in, like, how do you actually start to get ahead? And the first thing you got to invest is yourself, to get educated, to learn. Okay, well, like, if I was going to do this, how would I do this and not lose money? And don't just push out on the risk curve. Don't just go into the meme coin casino or start making high, I'm going to 10x leverage on Robinhood or something like that to go and buy. You got to play it smart. You got to accelerate your capital. And then once you've built up enough capital, you can then transfer that into a deposit for a property and start to explode your capital through the exponential nature of Australian residential real estate. Then once you get to a certain point, you can diversify again. So I sort of think about it in several stages. The first, if you let's say you're starting with $5,000, the first stage, you should be thinking about investing in Bitcoin and exponential age assets to accelerate your capital. Once you have enough capital, flip that capital into residential real estate. Play that game until you have a large enough net worth that you feel comfortable diversifying some of that capital back out, and then you start to build up a more diversified portfolio of those 3 buckets. That's how I think about it. What do you think about that?
I completely agree with that, and it comes back to this keyword education. There's a difference between investing and gambling.
Yeah.
So most people associate Bitcoin and crypto as the same thing. And we all know someone, maybe right now you're listening and you were this person who puts in all this money, could be $1,000 or $100,000 into fart coin or shit coin or dick coin or whatever it is. Then you lose all that money because it was a terrible fucking gamble. And then you blame Bitcoin because you don't understand it. So I don't actually know much about exponential age assets. I do know about Bitcoin because I've read the Bitcoin Standard, the Tao of Bitcoin. I've watched countless YouTube videos. I'm constantly learning about property through podcasts and other means of education. So if you're listening to this right now and you understand that your money is getting wasted away and burnt away, you want to build a future for yourself and your children, then start getting educated, right? And like Goose said, there's a trifecta. Pick one. Bitcoin, exponential age assets, learn about them. Don't just throw your money in. Do your research properly. Don't gamble. And then that way you can start to build that wealth. And I'm telling you right now, guys, anyone listening, you can build $5,000 into 100 into a million into 10. You can do it. There are paths and avenues out there. But if you're going to sit here and go, it's not possible, well, then you're right. If you believe that, you're right. But how can you make it possible? Now, Goose, we've covered a lot here. We have the property game, we have the Bitcoin game, we have the exponential age assets.
Yeah.
I want to talk about Dashdot and your journey and what you do for people. Before we do that, can you dive a little bit into Bitcoin and what makes it so unique?
So I, like many people, thought that Bitcoin was funny internet money. I didn't get it. I didn't understand it. And I'm a big believer that you shouldn't invest in things you don't understand. I think it's a little bit different with what we do with Dashdot because real estate is such a fundamentally complex thing that I think actually it's one of those situations where you probably won't understand it. So partnering with someone is actually the smart move. But if you don't understand an asset, like if you don't understand Tesla, if you don't have a core thesis of why Tesla is going to go up, don't invest in Tesla. Right? That's not a recommendation, by the way. If you don't understand Bitcoin, don't invest in Bitcoin because when it goes down, you won't know why it goes down and you'll freak out and you sell. And so
what's the simplest version you can help us understand Bitcoin? Like how can you take a novice who believes it's magic internet money and go, this is why I believe in it?
No. So that's where I'm getting to, right? But before I understood it though, I thought I'll put a little bit of money in and I'll try. And I tried twice. I put some money in and then it went down like straight away. And then I sold. And then, because I was like, this is scary. And I sold. And I did that twice. And I was like, all right, Bitcoin's not for me. Right? I'm out. And I just put it down for like 2 years. And then I was at a conference a couple of years ago on investing and global macroeconomics. And someone was talking about how Bitcoin allowed you to take your money out of the banking system. And how you could actually... It was the only way that you could truly own your own capital. And it was at that moment that it clicked that I finally understood the utility value of Bitcoin. Because all of the money you have in the bank is not your money. It's actually owed to you by the bank. It's not actually there. It's not yours. It's the bank's money and they're just going to owe it back to you. It's a credit note. And so once I understood that Bitcoin was the only mechanism on the planet or the best mechanism on the planet for you to truly own your own money, that's when I realized the real value of it. Because it is a monetary system. It is not, I don't believe that it's going to become an exchange for the dollar. I don't think it's going to replace the dollar at all. I don't think it needs to. But it is a monetary system that allows you to store your economic energy in a way that is not going to be corroded, diluted, debased, devalued, that is cryptographically secure in a way that is unbreakable, that is highly verifiable, highly transportable. So it gives you the ability to truly own and move your capital around. Now that is very, very, very liberating. It's also very scary because all of a sudden you actually are in control and somebody else isn't in control of your money. Now, what I think is interesting about Bitcoin is not only the fact that you, for the first time, can truly own your own capital without the interference or intermediation of government or banks or anyone else. You own your money. There is no other, like, you can own gold, I guess, and you could put gold in a safe. But you can't have $1 million worth of gold and cross a border. You can't do it. So Bitcoin is the first best and most effective medium to store your economic energy. It's the most pristine form of capital available on the planet today. And I think that is the most important thing that we can do, because at the end of the day, that is why we're investing. We're trying to store and transport our economic energy through time and space. Now, there's some other interesting things about it, which is one of the other interesting things about it is that it's permissionless, which means that anyone can access it. 40% of the world is unbanked. 40% of the world don't use banks. They can't access banks because they don't have enough money, which means that 40% of the world don't have access to the entire monetary system. In fact, something like 20% of the US don't have bank accounts. It's crazy. And so what Bitcoin does is allows the entire planet to have permissionless access to a globally connected monetary system that is not controlled or intermediated by government, banks, or anything else. And that's a very powerful mechanism, because that creates personal sovereignty. And that, to me, is why it is so fundamentally important. And we could talk about all the kind of technical nature of it, but if you just think about it from that perspective, that you can actually own your own capital, take it out of the system, and it's yours, that in and of itself is enough.
If you were to break down Bitcoin for somebody in terms of numbers, I mean, you've shared a few right now. We could probably go into ChatGPT. If you were to put $1,000 a month into Bitcoin for the next 5 years, and it continued to have even half of the compound annual growth rate, I think I've done the numbers before. Like that $1,000 a month, 12 grand a year over 5 years, the numbers become insane. I don't think people understand how insane some of these numbers can be. I calculated it for a client. If you put 10 grand a month into Bitcoin, which not everyone can afford, but let's say you're a business owner, you're making good money, you can save 10 grand a month. Over the course of 10 years, it was worth like $17 million or something like that. It was wild. So for the average layperson who gets to do their own research, what is possible in terms of a hurdle rate and wealth generation through a tool like Bitcoin?
Yeah. So one of the things I forgot to mention in my last little diatribe there was the fact that it's highly divisible is actually one of the most interesting things about it. So
you mean you can buy small amounts of it?
You can buy small amounts of it. Because people look at the Bitcoin price, and if you're in Australia, it's roughly about $150,000 Australian at the moment. I typically look at it in US dollars, because to me it's a US dollar denominated asset. So it's like 95,000 US dollars at the moment, something like that. So people look at a Bitcoin price and they go, oh, it's 100 or 150 grand. It's too expensive. I can't buy one. The thing about Bitcoin is you can own it to the 8th decimal place. So you can own a fraction of it. So you can buy Bitcoin for maybe like, I think the smallest denomination is maybe like 10 or 15 bucks, right? So you can get access to the most pristine form of economic energy on the planet with a very small amount of money. You can't do that with real estate. You can't buy a Berkshire Hathaway. If you're like Warren Buffett, you can't buy a Berkshire Hathaway share for that price. It's like thousands of dollars for a Berkshire Hathaway share. So that accessibility is really, really, really important. So, and that's something that I really want people to understand as well, because they can be daunted by the fact that it costs so much money. It's $150,000, but you don't need to own that. Now, because it's a fixed supply network, what that means is that your money is not going to get devalued over time. So even if you own a little bit of it, that is you're still owning the network. Now, the compound annual growth rate of Bitcoin since it started is more than 100%, but that's because it started from a low base. If you look at the last 5 years, the compound annual growth rate is between 50 and 60%, depending on exactly when you measure it from. So 50 to 60% compound annual growth rate in Bitcoin over the last 5 years is pretty good.
So for anyone who doesn't understand compound annual growth rate, every single year after year, it's gone up by 50 to 60%.
Yeah. So let's say it was $100,000, then it's 150, and then it's 100 and what would that be? 215,000 or something like that.
225. Yeah. So it goes from 100 to 150 to 225, and it just keeps going exponentially up higher and higher and higher.
Exactly. Now it's volatile, so it goes up and it goes down and it does all this kind of stuff. But over a 4-year period, you have 100%. Since it was invented, discovered, or released in 2009, over any 4-year period, it's got a 100% success rate of people making money, right? So no one's lost any money over any 4-year period. Pick
Unless you sell, just caveat.
Unless you sell, yeah.
If you hold on to the asset and don't freak out and just stay calm, you would have made money.
If you hold it for a minimum of 4 years,
yeah,
you have a 100% success rate in making money, which is crazy, right?
Yep.
Now, my point of view, and this is my point of view based on my research, is that Bitcoin will be worth $1 million US by the year 2030. So that's my point of view. That's how I've and that's a lot lower than a lot of other people say, by the way. That's a lot lower than a lot of other people say. So I don't think I'm being hyper bullish, and I've done all my own calculations to arrive at that point. And so I look at that and I go, okay, so let's just round figure say it's worth $100,000 today. In 5 years' time, do I think it's going to be worth $1 million? Yes. That's potentially 10x upside in the next 5 years, which is pretty bloody good. Now, what if I'm wrong by 50%?
Yeah.
Like what if I'm, because I always like to do that too, because it's very easy to get excited, right? But what if I'm wrong by 50%? I mean, that's a pretty big margin of error. I'd have to be pretty wrong. That's still going to be a 5x in the next 5 years, which, you know, you could do better in Australian residential real estate, but it's still not bad, right? You're still going to beat your hurdle rate of 20%. And so as far as assets go, it's an asset without an issuer. It's a commodity. So you don't need to worry about a CEO losing their marbles or you know, like you look at Tesla. I like Tesla, and that's not a recommendation for anyone to go buy Tesla. But one of the big risks of Tesla is Elon Musk. You don't know, like, you know, what's he going to do? Like, what if something happens to him? What if there's all this, like there's a premium built into the share price based around Elon Musk? Like if he, God forbid, if something happened to him spontaneously, the share price would be significantly impacted. Whereas Bitcoin is an asset without an issuer. It's a true commodity. It's recognized as a commodity. So you don't have all these risks associated with it. And in fact, it's one of the very few assets on the planet that the more valuable it gets, the safer it gets, right? The larger the adoption, the higher the liquidity, the safer it becomes, the more valuable it gets. And so right now is probably the best risk-adjusted return basis you're going to get, because it'll become safer as we go forward, but the returns are probably going to go down. I don't think they're going to stay at 50, 60%. In fact, I'd have to look up I did a bunch of calculation on it, but I basically have it on an asymptoting or a declining growth rate curve that goes down to about 25% compound annual growth rate by I think 2035. So over the next 10 years, it goes down to about 25% compound annual growth rate, which to me is great, right? So I'm very happy with that as a portion of my portfolio.
Before we go on to the final piece, what would the compound annual growth rate be for it to get from 100,000 to $1 million though in 5 years? Wouldn't that be much higher than 50%?
I would have to look up my maths on that.
Yeah, I'd be very interested to know that. I'll probably drop it in the show notes. Now, Goose, we've covered a lot of technical terms and we've simplified it for the listener to these 3 areas: Australian residential property. We've explained why that is the specific niche. Bitcoin, sovereign pure money, and then what was the term you used? Future
exponential age assets. Yep.
Exponential age assets. So anyone listening right now, I'd recommend you do your research. But Goose, you run a company called Dashdot. And look, anyone listening right now, this is just simply me sharing my experience. Goose, I've coached him. He's coached me. We've known each other for years. And I actually met you, Goose, in Bondi 5 years ago. And I sat down with you and I had so many of these old thoughts. I can't afford real estate. What if I buy in the wrong place, etc. And I remember at the time, I was being pushed to do a new build. I was like, I'm going to invest in property, go to a new build. And your company, Dashdot, at the time, would find properties in the right place, the right time, the right location, all that sort of stuff. You'll share it. So I'm being pushed to this new build. The new build, the guy actually went under and got sued and lost $25 million of investor money. I went to work with your company, Dashdot. We bought that first property for 420 grand. We're about to sell it for 860. And through that experience, I've bought 7 more properties. I found an amazing team around me, including yours, and I'm well and truly on my way to wealth. And I cannot understate the value of the freedom I feel because of those decisions. I am able to now work 5 hours a day, even though I find that difficult, and spend time with my daughters. I don't have to worry about the cost of anything. And I'm not saying this to brag. I've worked fucking hard to get here, but I know that I wouldn't be here if it wasn't for my decision to invest in real estate. I also realized that I didn't do it on my own. I don't know where to fucking buy. I'm a business owner. I'm busy. I've got a family. I don't have the time. And that's where Dashdot came in. So to anyone listening right now, if you have equity, if you have savings, if you want to learn more about property, you guys have a podcast, you have a service that does that for people. Could you quickly speak into the credentials of Dashdot, what you guys have done, how much you've grown, and the technologies you guys have for anyone who's interested?
Yeah. So I just want to speak to that freedom you feel, by the way, because it's very, very powerful. Because that is actually the entire point, right? It's the entire point. Like the reason you invest is so that you can actually feel that kind of that level of freedom and satisfaction and liberty in your own life. And I think that's very, very important. And this, just quickly, I think there's 3 stages to financial freedom. There's financial confidence, where you have the skills and capabilities to kind of carve your own path, and no matter what life throws at you, you're going to stand on your own 2 feet. Then you have financial security, which is when you have enough assets that if something were to, the value of your assets is large enough that if something were to happen significantly in your life, that you would be safe and secure no matter what. If you could, maybe you need to stop work for some reason for several years, you're going to be fine because you've built enough assets. And then there's financial independence, which is when the income from your assets replaces the income that you generate outside of that, and you no longer need to trade your time for money. The biggest transformation that I see with people is when they get to the stage of financial confidence, which typically happens at about the second or third property that they buy, maybe even the 4th property they buy, where they suddenly go, it's like this is like sigh of relief that kind of like comes through their very energy, where they're like, everything's going to be okay. Everything is going to be okay now. And it's like an awakening. Once you realize that everything's going to be okay, this tension is relieved from your life. It's wild. I've seen the biggest we've helped many people go all the way to financial independence, but I've seen the biggest transformations happen when people realize everything's going to be okay because I found the path that I can walk that's going to get me to where I need to go. And they might still be 5 years away from from their destination or whatever, but they know like everything's okay. It's wild. So when we started the business back in 2019, we had $5,000, no safety net, no backup, no nothing. We'd never worked in the industry before. We didn't know anyone that were property investors. We didn't know anything, right? We had our own journey. We'd bought the wrong property in the wrong place at the wrong time and lost a bunch of money. And that caused us to then go, well, how does this work? Like, why do some properties go up? Why do some properties go down? And how could we find the answer? And at the time, the answer was trying to find the answer for ourselves, because we were in dead-end jobs in an industry that was dying. And we knew that if we didn't get ourselves out of the quicksand, we were going to go with it. And we didn't want that life. We wanted to create freedom for ourselves. And so we thought, let's go invest in real estate. And as I say, we bought the wrong property in the wrong place in the wrong time. That was the eye-opener. That was the awakener that set us on a path to try and work out, how does this work? And the interesting thing about real estate is it's the single largest asset class in the world, and it's also the least understood. In Australia, it's an $11.3 trillion asset class. It's larger than every other asset class in Australia combined. It's larger than stocks, bonds, everything combined is the Australian real estate. It's massive. And it's very, 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 very complex. For someone like me, that's really interesting because I love complex things. And so when we started the business, it was really interesting actually, because we were very excited about real estate, and we'd developed some ideas and some theories and some theses, which we tested on ourselves, and they worked. And we said, you know what, let's start a business around this. Let's see if we can help people avoid the mistake that we made, at that point about a year prior when we bought the wrong property. And our grand vision at that time was, imagine if we could help 10 people. Imagine if we could help 10 people to, avoid making the mistake that we made. That was as big as it got. And as I say, we had $5,000 to our name, and it was like we were flying by the seat of our pants. And I remember our very first client, Lucas, who's still a client today. When Lucas came to us, he had tried investing before. He still is a husband and father of 2. But that was who he was when he came to us as well. He'd bought 2 properties in the past, I think, or at least 1, maybe 2, I can't remember exactly, off the plan, new build type stuff, and he'd lost money, and he was feeling like a failure. He was failing his family. He was failing his future. He was scared, and he knew that he had 1 shot left. He was terrified, man. He was like, it was harrowing to him. But he knew that he had to try and find a way out for his family, but he also knew that he'd stuffed it up and he didn't trust himself anymore, and he was looking for a better way. And he was our very first client, right? And most business owners, when they get their first client or they talk about their first sale or whatever, it's this like hallelujah moment. Oh, my business is real. It's like this like celebratory event. And I still remember vividly, because every single time I think about it, I still get the same emotion. When Lucas agreed to work with us, and when he, signed up to work with Dashdot or whatever, I realized in that moment that he trusted me more than he trusted himself with his financial future. And I was like, oh my God, this is wow, what a responsibility, what a privilege, but what a tremendous responsibility. And I was like, I thought to myself, I'm like, well, what if we stuff it up? We're good people. We want to do good work. We have the best intentions. We're not here to rip anyone off. But what if our best efforts weren't good enough? What if we did our very best work and we destroyed Lucas's financial future? And I was like, oh my God, this is the biggest possible undertaking that we've got. Now, Gabby and I are very mission driven. And so that was both a wake-up call and also a great inspiration for us. And so since we started the business, we've basically invested 100% of our profits back into the business to develop technology and tools to help people succeed in real estate. Over the last 6 years, we've invested about $6.5 million now in two very specific domains: portfolio intelligence and real estate market intelligence. And when we very first started out, we started trying to work out how to find the right locations. So we managed to work out how to get into the locations before everybody else so we could get maximum market growth. And then we realized that every individual is different. And so everyone needed a very unique portfolio plan tailored to their own specific needs, goals, financial characteristics. So we invented technology to do that. And then we had to realize we had to work out where the market was going. So we invented price and rent forecasting models so we could see into the future and try and understand that. And all these technologies have never existed before. We've invented technologies to invent technologies to then go and invent other technologies, like 3 layers deep of invention to just create stuff. We've created proprietary data sets that don't exist anywhere else on the planet. The things that we've managed to do in the company are just mind-boggling, and we're working on some stuff now which is going to truly revolutionize even the concept of real estate investing by introducing modern portfolio theory to real estate, which has never been done anywhere on the planet. Now, all of that has been driven by wanting to see our clients succeed. And that client-first focus, I think, is actually one of the reasons why we've grown so quickly. So when we have been one of the fastest growing companies in the country over the last few years. I think we grew 22,000 or 23,000% in 4 or 5 years. So we've definitely had significant growth.
I should have put my money into you guys, not into property.
Yeah. Well, yeah, no, there's actually we've grown faster than Bitcoin. MicroStrategy's overtaken us now, but for a very long time, we'd grown faster than MicroStrategy and Nvidia, which is pretty fun, which is pretty cool.
Really quickly as well, I think one thing that stands out about you that probably other people don't know is that, yes, you help people find the right property in the right place at the right time, but you also have a business that is so driven on adding value to your clients. I mean, I think you've grown from a team of 2 to a team of like 120. Yep. You understand the stresses of business. You understand taxes, super, wages. Yep. You understand how hard it is to not just make money and keep it. And you've always stuck true to the mission, which is invest everything into the business. And there's so many companies out there that label themselves as like buyer's agents and shit. That's not what you guys do. You guys are like a technology-based company, right? That really, I've seen your models, and anyone who's interested, we'll drop a link down below. You guys have literally shown me what's going to happen to my 8 properties. And it not just happened, it exceeded. Yeah. And that's what gave me a lot of confidence to invest in property. Because when I'm going to give somebody my future for my daughters, I need to be able to trust them. And I think what you guys do is just so powerful. It's so hard to explain on a podcast. Yeah. I just wanted to bring that point up.
It's a great point, right? So I mean, look, a buyer's agent is a shopping service. A buyer's agent is someone who's going to go buy your house. You say, hey, can you go buy me a property in wherever, name your suburb, and I want it to be like this, and they'll go do it. It's a shopping service, effectively. Yeah. What we have built is we didn't sit around and say we want to be buyer's agents. We sat around and said, what do our clients need? How do we build that? And so we have built. We are primarily a technology company with a client-first focus. So we build the technology to create a human and client-centered experience, and we consider ourselves to be portfolio growth partners. So we have a 4-part portfolio growth system that starts with planning, financing, acquiring, and optimizing. So we start by using our portfolio intelligence technology to build robust and sophisticated plans. And to your point, Tony, we build plans that are conscientiously conservative because we'd rather our clients exceed those expectations than underperform them. And so that happens almost 100% of the time where our clients are outperforming the plans we build. But the plans are robust and sophisticated, and we've had data scientists working on them for like 3 years. Like they're insane. We've built AI into them now, and it's our own proprietary AI, by the way, not just some kind of plugin. We have our own capability to finance as well, but then we use our real estate market intelligence to help our clients to acquire the right property in the right place at the right time based on their portfolio plan. And there's some considerations in there as well that building a successful portfolio isn't just about stacking up properties. It's not just stacking one property after another. You actually have to, a very unique approach that we have, which nobody else has, is we apply the theory of constraints to property portfolios. And there's 3 constraints in every portfolio: access to capital, access to debt, and access to cash flow. So we look at a property portfolio holistically by understanding where is it going to hit its constraints first, and then optimize around that so we can help our clients continue to grow. 71% of property investors never get past the first property. 19% never get past get to the second. So you have 90% of property investors never get past 2 properties. Less than 1% of property investors ever get to 5 properties. And in my experience, and through our company, we've built more than 3,000 portfolio plans now. I haven't seen anyone who can achieve financial freedom through real estate with less than 4 properties, and only about 1% get to 4. So realistically, like 99% of people are never going to get there, and we've built systematic pathways to help our clients do that. And that's a combination of service, science, and software to help people to get there. Now, as a kind of a proof point on that, by the way, we've bought over $1.2 billion worth of real estate now. We've bought over 2,000 properties. We've had 100% success rate with our clients. The average return on invested capital in the first 12 months is 73% return on invested capital. So this isn't, so we talk about hurdle rates, right? So the average year 1 return on invested capital for our clients, averages are averages, some more, some less. But the average across 2,000 purchases, over 2,000 now, is 2030 last I checked, is a 73% return on invested capital in the first 12 months, which is insane. So our entire goal, and even the reason, like, yeah, we have a real estate company. Why am I talking about Bitcoin? Why am I talking about exponential age assets? Well, it's because the actual thing I really care about is helping people financially succeed. I happen to think that real estate is the apex asset that you can own if you're an Australian, or you can access Australian lending. And we've built technology and systems around that. But I'm also not going to sit there and bang the drum and say it's the only thing you should ever own. The thing that matters most is helping people to achieve economic freedom and economic sovereignty. And so we've developed a specialization in the real estate side of things. And yeah, I mean, our clients have become wildly successful because of that. And yeah, we've grown a massive company in the meantime. You know, we have 124 team members now. You know, we grew from a team of 3 to a team of 85 in 18 months. We've had no venture capital funding. We've had no private equity. We've done that all bootstrapped. And it's been a very wild ride. Yeah.
Amazing. So I have 2 questions to close this out. Simple English layman's terms, somebody wants to build wealth, get into property, even if they just have a plan, they might not be able to buy the property yet. Give me as concise summary as possible. How can Dash help?
Did you say if they don't have the money to buy, or they do?
They do have the money to buy. They want to get into property, or they want to plan. I don't know if that's what you guys do, but yeah. How can Dash help?
So I think anyone who's considering getting started in property investing needs to start with a plan. Because if you don't start with a plan, how could you even know if the first property you want to buy is the right one? And so that is why our process starts with planning. So in a very simple format, if you feel like you're financially ready, you know, if you can borrow, if you go and speak to a mortgage broker or do a borrowing capacity assessment, and you can borrow at least $250,000, and you've got at least, say, $70,000 to $80,000 of capital to get started, then the very simple format is book a call and have a chat with the team. Because we have a team of 124 really passionate people who are as dedicated to our mission as serving people as I am. And that's one of the most amazing things. And the very first step is to build a plan. That's the very first place you need to start, because without a plan, you actually don't. You're just shooting in the dark. So we start by building a plan. Once we have a plan, then we know what. That's the kind of what. And then from there, we look at the where. We go, okay, well, based on that plan and based on your financial considerations and your goals, where on earth, or where in this country would we find the right property in the right place at the right time to specifically fit your needs? Then we would help you to acquire that. We'd take all the work out of it. And then we'd manage the entire process of the acquisition all the way through settlement. We'd help you to find the right partners. We'd manage those partners along the way. We'd do everything and really set you up for success. And then we'd hand that off to a property manager once we finish the acquisition. And then we continue an optimization phase as well. And the optimization phase is really, really important, because buying a property is great, But actually what you want to know is you want to know, how do you continue to optimize your portfolio to find success over the long term? How do you know when to sell different assets? How do you know when to buy more? In fact, is another really good point, because your plan might say, hey, buy another property in 18 months. But what if your property has performed really well? And what if you could buy another property in 8 months? You're going to collapse that timeline to financial freedom. So the optimization part is really, I kind of think about it as a bit like a personal, a personal trainer, but for your property portfolio. We're looking at it, we're going, okay, where are you at? What's the next rep? All of this kind of stuff. How do we push you to help you get to your goals sooner, and using technology and data to guide those decisions? And so then it becomes basically a flywheel, and you've experienced that flywheel yourself, where it starts to speed up and compound, and you've got the support network around you. So that is what we do. We plan, acquire, optimize. We have a finance piece in there as well. And that's how you continue to get to your goals.
Amazing. Anyone listening right now, I cannot speak highly enough of Goose and the team. Like, it's changed our lives. So if you are interested in property, you've got the borrowing capacity, you have a deposit, the least you can do is just get some clarity, talk to their team. We're going to drop a link down below. Go click it, check it out. Worst case scenario, you learn something. Best case scenario, you change your life. Goose, I have one more question for you. You've built a team of 120 plus people. You've been through the business prison, the stress, the what the fuck am I doing, the pressure, the chaos. To anyone listening right now who has listened this far, they're clearly committed. I know this is a loaded question. What would you say to that hustler, that hard worker who's just doing their best to provide and have a great life? What is the one piece of advice you would share with that person that they can leave this podcast with?
I don't know if that's that loaded of a question, Tony.
Well, it's quite pointed, right?
Yeah,
You know?
I think it's quite pointed. And what I would say, and this is maybe not what you would expect me to say either, is you can have whatever you want in life. All you need to do is decide what that is, and then act accordingly. And I think most people get lost in prisons in their own mind, and they don't actually make progress towards what they really want in life. They hustle and grind, and they exchange in their mind the value of work with the value of progress, and those two things are very different. And as someone who 8 years ago was an alcoholic drug addict that was homeless, and who 6 years ago started a business with $5,000 to his name, I can tell you that you can create anything you want in this life. All you need to do is decide what that is and act accordingly. If you're stuck in your business, feeling like you're grinding it out and not getting anywhere, stop, change your perspective, ask what you really want, and then go towards that. If you want to create financial freedom, stop, ask yourself what would be required for that to be true. Go and take action towards that. And stop getting in your own way, because freedom is available to you to the degree that you want it, as fast as you want it.
So powerful and so true. Goose, this has been an absolute pleasure. Thank you for sharing your wisdom. Thank you for changing my life, and more importantly, my family's life. I'm so grateful for you and what your company does, and I can't wait for the listeners to experience it. We'll see you next time on the Empowered Man podcast.
My pleasure. Thanks, Tony.
If you want to actually take this framework that I shared and apply it to your life, it's part of our Empowered Man Armory and our app that we've spent almost 250 grand on. If you want access to a powerful system where you can use this reframe system I just shared with you every single day, then find me on Instagram at Toni Empowered Man. ToniEmpoweredMan. I'll put the link down below as well. Send me a DM saying reframe, and I'll give you this exact framework as well as early access to the Empowered Man app when it launches.